Good evening, everybody. Thanks very much for joining again. Tonight I want to talk about support and resistance principles, particularly when it comes to looking at trading indices. And I'm going to concentrate on the US Tech 100 index and highlight how I approach that particular index using support and resistance and how we can apply it to look at trading opportunities and next support and resistance levels that we need to monitor. So basically, to start, just to run through very, very quickly the basics of support and resistance, we have the first most basic definition of support and resistance area is a previous low or high where buyers or sellers have been previously active. And this basically means a level where the market's traded into, found support or resistance, reversed and moved within the direction, or reversed and moved within the opposite direction of the original move. Now this is important because even historically, when we look at previous highs and lows within price action, they quite often act as a support or resistance area because we know that traders were active in that area previously, and that will continue to hold and limit price action. Now, within a sideways trading range, support and resistance levels are horizontal, and that pattern will remain intact until either the buyers or the sellers actually win the battle that's going on between the bulls and bears to break out either above the resistance or below the support to highlight the direction of the next significant move. And the trading range will remain as long as this battle between the buyers and sellers continues. And as I say, it's only when one becomes the dominant force that we start to see a significant move in price outside of that range. Now, often when we see a breakout from this type of sideways trading range, the market then develops an uptrend or a downtrend. And this reflects where buyers or sellers are more dominant. So buyers for an uptrend, sellers for a downtrend. Now, what actually tends to happen within this type of situation, if we talk about a downtrend, for instance, recoveries in price run into selling pressure at a lower level each time. So the resistance point will be at a lower level, and the sell-off will break below the previous correction low, which should be a support point, or initially will be a support point, but then it gives way to show that the sellers are the dominant force within price action, and that this forms the basic definition of a downtrend: lower highs and lower lows. So as long as we see this pattern of lower highs and lower lows within a downtrend, or higher highs and higher lows within an uptrend, we know that the market is trading within a directional bias, be it to the up or to the downside. And that can be quite important when we're looking at support and resistance levels to develop within that trend. Now, when we come to monitor support and resistance levels, they can also be reflected by moving averages, the Bollinger mid-average, and Fibonacci retracements. So we need to incorporate these tools when we're looking at markets in terms of support and resistance. And we can use support and resistance levels to either close trades. So we initiate a trade and we have a support point if we're short of the market that we're looking to close against, or we're looking for the market to rally back and use that as a selling opportunity to initiate short positions within a downtrend. But obviously we need to be aware of the directional bias of the market. So we need to be aware of not only the short-term view if you're an intraday trader, but you also need to be knowledgeable of the trending conditions for the longer term perspective, be it a daily chart or even a weekly chart, because often they will flag up some very important long-term support and resistance levels that you need to be aware of that perhaps could even hold or even reverse your particular trade. So you need to be cognizant of whether or not you need to close positions against that area. Okay, so let's look at the US Tech 100 index, and this is a daily chart. Now, you can see that the general pattern is towards lower highs and lower lows, so a downtrend. Now, if we were to draw a trend line connecting those recent highs, we would basically say that if the market rallies back to this resistance area, chances are that we would fail again and look to resume the downside activity. However, you can see that this particular trend line, this downtrend, is some way above current price activity. So the market would have to rally a significant amount for us to actually say, well, we're now back towards this resistance area. And of course, this downtrend wouldn't have been confirmed until this period here to give us a third point of contact to confirm this resistance area. So we would then perhaps look for a shorter term trend to draw in and highlight that perhaps as an area that gives us a shorter term resistance point. And you can see that we've drawn in the trend connecting these recent highs to give us a trend line resistance much more closer to price action than the previous longer term trend line. So we're aware of this downtrend as a resistance area and we know that the general market trend is lower. So we would rather be looking at strength as being a selling opportunity. So we're looking for resistance areas to initiate short positions, looking for this downtrend and this longer term bearish pattern to continue. But again, you could argue that this is still some way above price action if you're looking from a shorter term perspective. And again, these highs here were required to be posted to connect with this previous high to confirm this as a downtrend, to give us those 3 points of contact to confirm a trend. So we would have missed this opportunity to go short of the market against this trend line resistance. So were there any other ways that we could have monitored this area as highlighting a resistance focus? Well, rather than downtrends, I tend to prefer previous highs or previous lows as an important resistance point within a bearish trend. So in other words, as the market rallied back, we approached these previous support levels, these previous lows from which the market had rallied and then attempted to rally before we broke lower again, and that acted as a resistance point. So even though we were back to this downtrend that we drew in previously, but this activity was only just confirming it, we were also back towards quite a strong resistance area offered by an old support level where previous lows were seen, which then, having been broken, becomes a resistance area. And that's an important point to bear in mind when we're looking at price action highlighting resistance points. Now, this isn't always an exact science. You could say that, well, we broke above that last recovery high and we failed to see a significant move to the upside, and we failed back having found resistance around these previous lows. And that's very true. But if we also then bring in Fibonacci retracements to this move, we look at a significant high and a significant low and run the set retracements, the 38%, the midpoint, and 62% retracements. And we can see that at these highs, as well as moving back towards this resistance offered by the previous lows, which then become resistance, we were also back to the 38% retracement resistance within price activity. So there were a number of factors to suggest that this area was going to be a strong resistance and a potential failure level within what was a longer term ongoing bearish trending condition. And then subsequently, we've seen the market sell off and make new lows to extend this bearish pattern. So we would then look to run the retracements on this latest sell-off to highlight the next retracement points and resistance levels within what is still a significant downtrend. Now, it's important to be aware of all timeframes, and this is a weekly chart of the US Tech 100 index. And the reason why we continue to talk about this as a bearish trend at present is that if we take a significant low and a significant high, March 2020 and November 2021, and draw the Fibonacci retracements, you can see that we've just broken below the midpoint of that long-term bull trend. So the fact that we're still seeing lower highs and lower lows suggests that we're still trading in a bear trend and in a bearish trend. We're still breaking support levels. The midpoint was an important focus. So this maintains the negative themes dominating within the market. and that would suggest that we could move back to initially the November 2020 low at 10,941, or even the deeper 62% retracement at 10,498. These are all support levels that we're aware of within price activity, even if we're trading from a shorter term intraday perspective. Just by looking at the weekly chart, we can be aware of potential long-term support points that we can build into the other time frames, be it daily or intraday perspectives. So the risk is that we're still, having broken this latest support level, trading within a bearish trend. Now, when we look at the 4-hourly chart here, again, the same index, the US Tech 100 index on a 4-hourly basis, we can see again that lower highs are still very much in place. But when we run the retracement levels using this significant high and this significant low, you can see that 11,788 is the 38% retracement level. Now, don't forget that we've actually calculated it off this low, so it's not this low. So as the market rallied back, this wasn't a retracement level to act as a resistance point. But this retracement level now coincides with a previous high, and that's an important resistance focus to the upside. So again, we're aware of bearish conditions that are, from a trending perspective, support levels are being broken, and we're concentrating on these more important resistance points if the market rallies back to be a potential hold level, failure point, and an area that can extend what is still an ongoing longer-term bearish position. So by using these support and resistance levels across all time frames, we can get a great feel for where markets are likely to fail within strength within a downtrend, or stage a more sustained recovery within the downtrend, or even produce a reversal point, because we're aware of those significant long-term support points below the market. So that's me for tonight. Thank you very much for listening.